In this video, I'm going to show you the UK stocks that I bought this week, as well as the top riser and faller in my portfolio, and also give you the share tip of the week. If you enjoy the video, please drop me one of these to support the channel. According to Google Finance, the FTSE 100 is up by 0.49%. The FTSE 250 is up by 1.19%. And surprisingly also, the S&P 500 is down by 1.19%. My portfolio has had quite a respectable week and has risen by 3.99%. Although in the grand scheme of things, we're still below our all-time highs, which were approximately reached around 2 months ago, suggesting that with the amount of deposits I have put in since then, and I've not calculated it, that we are still significantly under where we were performing previously. Regardless, it is a steady step in the correct direction, and hopefully I can get back to being able to compete with the S&P 500 and then bragging about it on the channel. The three top topics of the week start with Softcare, in which they had a trading update. There was a lot of low investor sentiment with Softcare, and that was prior to their preliminary results. Effectively, they had a gloomier outlook for the future, and they hadn't done as well as perhaps people may have expected, which had led to their price dropping fairly significantly. And this for the last few months has been downtrending. However, this week they had announced that they were doing better than expected, their cash generation remained strong, and that they had actually done better than the first quarter of the last year. Furthermore, Softcare have also achieved their recruitment target. Now, I didn't look deeper into this, so this could just be one person, but that's still quite a change from a lot of the businesses that are currently cutting jobs. It's nice to see that Softcare are actually looking for employees, or had been, and that they are able to be able to afford the cost, which at least tells me that the business is doing somewhat well, if they are still hiring people. A new exciting electric vehicle company, which had been described as a mini Tesla in the UK, had decided to actually list not on the London Stock Exchange. In fact, they had decided to list in the Nasdaq, the US stock exchange. I find this very interesting because of their valuation, and that's because it has been valued at £4 billion. And I feel that the US investors are going to eat this up, and it'll probably double in valuation to £8 billion. But what's interesting about it is at £4 billion of a valuation, that makes it a bigger business than Boohoo currently. Obviously, I know in the past Boohoo was higher, but that makes them a bigger business on market cap than Boohoo. Furthermore, this business, right, wait for this is huge information. They have a prototype for a van and are currently looking to develop a bus. This van, they have a few working prototypes, and yes, they do have an order book of 10,000 small vans from UPS, but that's it. They don't have years of significant growth. They don't have reliable product. They don't even know who they're really marketing it to, yet they would be valued at £4 billion. I personally just couldn't buy a business like that, and it's very likely that they are unprofitable. But then again, I haven't looked into their financial records, and I do not ultimately know. I do think it's a wise move that they are marketing to the US, as they seem to have a lot more retail investors that would likely put a significant punt into it. I'm quite curious, would you actively buy shares of this company, which is a rival, when they IPO in the US? Lastly, Halma had their half-year results, which was on November 19th, and these were deemed as more resilient. This is because whilst their revenue had decreased in the UK by 17%, overall their revenue had only fallen by around 5%. And this is because a lot of their major regions were actually heavily impacted by the pandemic, and they've actually done better than expected. Furthermore, they had grown their dividend by 5%, marking, I believe, and this is off the top of my head, the 47th year of consecutive dividend growth, although that may be wrong. I know it's definitely around the ballpark of around 3 to 4 decades at least. This is a stock I'm very happy to be holding. I've not topped up yet, although I hope to have at least topped the position up quite a fair bit by the end of this year. And that's not financial, this is by the end of the new year. Before going on to the top riser and faller, I would like to disclaim, and that's because these screenshots on the left hand side of the screen are going to have inaccurate share price movements, and that's due to the Freetrade app. And so instead I'm going to be using my figures from simply Wall Street, and this is because Freetrade is too busy trying to market an unfinished product, or more commonly known as Freetrade Plus. But at least they've updated their icons at the bottom left of it. So the top riser of the week is actually my biggest holding in the portfolio, which is Boohoo. Their shares had actually risen by 8.05%. I did not look at a prompt. And this is likely due to the aftermath of the investor movement. Obviously, we had seen when the vaccine announcements had happened, I believe 1 to 2 weeks ago, that we had a shift from these technology stocks or stocks that would have benefited from the pandemic and moved it towards these value recovery plays, such as the airlines. However, I feel that this is slightly going backwards in the other direction, and that's why we've seen this upwards trend with Boohoo. Furthermore, though, they had appointed a new non-executive director, who is also the Trainline Chief Financial Officer, and his name is Sean McCabe. I'd actually announced this on the Twitter, and if you're interested and you'd like to follow me, I'm at Osborne Foreman on Twitter. Shameless plug, I know. And he's actually formerly an ASOS International Director, so that is quite a nice boost for Boohoo, and it is expected by the markets that they will be appointing a new non-executive director that has had previous experience with ethical, social and governance monitoring. Regardless, my position with Boohoo will remain to be 2,500 shares. I'm not going to be acquiring any more unless something significant happens to the share price or the business. I've said before that if there are major governance concerns that do crop up further, then I will likely be liquidating my position. But if the share price goes below 250 pence per share, for no real substantial reason other than a media article slamming the company again over something that is not their entire fault, then I will likely be topping up. Although we've not had an update on the situation with their auditor, so I don't think that this growth that they have in share price is currently sustainable. And therefore I do expect this stock to be trading sideways for likely the next month, maybe 2, until they do find an auditor. Although after that point it may be priced up quite significantly. On the other hand, the top fall of the week is the London Stock Exchange Group, and I feel that investor sentiment had been lowering, and that's because investors were slightly more worried about the Refinitiv acquisition not being successful. Furthermore, this is because their competitors had actually flagged up to the EU regulators and are actively saying that it would be unfair competition if London Stock Exchange is allowed to acquire Refinitiv. In the past, the EU regulators had flagged the potential concern with having too much of a monopoly, and that's because they had the Italian subsidiary market arm. So they had actually went to appease the EU regulators by selling off this arm, and it's currently in the process of being sold, although they bought it in 2007, although this is from the top of my head, and I believe they've got a significant markup, and I think they'd at least doubled their money, so it is a positive outlook, and the share price is still down. LSE shares have actually fallen by 3.1%, and this was one of the stocks that I bought this week. I bought an additional share, marking my total holding to 5 shares, which is still 66% lower than it was 3 months ago. But I do hope to rebuild this up, and I do expect that this Refinitiv transition may take longer than the general market expects, or even the business. The business suggests that it will be done the first financial quarter of 2021. Although I suspect it may take longer, that gives me time to build up the position, and if it wants to continue falling in share price, who am I to complain? And if you sign up to Trading 212 using my link in the description down below, you can get a free share worth up to £100 when you deposit just £1. The other stock that I had bought this week is in fact my favourite UK stock, or more commonly known as Games Workshop. They have fallen quite significantly from their all-time highs, or even highs of like 2 weeks ago, which was around £124 per share, to now around £99 per share. I think this is a much better value, especially considering this is a premium stock that is at a considerably cheaper valuation, and therefore I had bought one more share. But this is also considering that they had profit estimations, which was not even 2 weeks ago, where they had stated that they expected to get at least £80 million in profit compared to the last year of only £59 million. But yet investors had likely sold out of this, and I understand why, because obviously with the pandemic and now that we have vaccines, it means that there's less likely to be more lockdowns, and therefore people are going to have less time available to play this particular hobby. But I disagree with this sentiment and feel that this will likely price up. Furthermore, with my smooth brain knowledge, I believe that they will be announcing a dividend next week for my birthday. I'm just kidding. I know I've probably got as much zits as I've got bad jokes in this episode, and I will cool off. But according to dividend data, last year on November 19th, they had actually announced their dividend for Q3. I suspect this trend will follow, and within this week, they will announce their next dividend for the Q3 of this financial year. I'm going to take a guess here, and this is completely a guess. I believe that they will upgrade their share price, their dividend, from 35 pence per share to 50 pence per share, which would mark up the total dividends per share from 160 pence to 175 pence per share. This is completely a guess, but if I'm right, that's one for the ego, I guess. If I'm lucky, I'm going to try and purchase an additional share of Games Workshop next week, as I expect the shares may rally up a little bit as they regain share price. Interestingly, I think the Share Centre has actually stopped doing share tips of the week, which is a shame because I did find it quite interesting to look at. This might be because they had been recently acquired, and I'm not sure who by, but it's by another big broker. But that doesn't mean I'm stopping, and this week I have a lower risk dividend growth play listed in the FTSE 100. Recently they had lost a significant amount of share price, and there are a few issues that could be present, but I really like this stock as they have an excellent track record of dividend growth, and they'd grown it every single year for at least the last 20 years. Although in the last 2 years dividend growth had only just beaten inflation. Whilst their balance sheet does leave a little bit more to be desired, they have a very strong cash position of around £1.2 billion, which does cover their debt loads. This stock is a highly cash generative business. They also have a dividend yield of 2.93%. More recently they had their results, which this stock was very much expected by the markets to be a resilient performer during the pandemic and to, if not, benefit from it. Although that's not really been the case, and this is why their share prices dropped. Whilst they were able to increase their earnings per share by 16%, their total turnover or revenue had actually decreased by 2%. Which isn't a very sustainable figure, as obviously if revenue keeps decreasing, it's not a good outlook for the future. But they were very hit by the pandemic. But this is also a software stock that provides accounting software solutions, so you would expect it to be more resilient in these time periods. If you hadn't guessed already, this stock is Sage, or SGE. They are the largest software company in the FTSE 100, and they are now a pretty cheap valuation that I'm very tempted to buy into. I believe that they have a resilient business model, but obviously the concerns are that their management hasn't been that innovative, and they've been very slow historically in adapting to the future and modernisation. However, if this is to change, and the plus side, which I'm going to talk about just now, is that they are starting to invest additional amounts of money into their business cloud software. So hopefully they see this as their forward path for further growth, and therefore they put more money into investments or R&D, research and development, and hopefully that this business can get ahead of that trend once more, become more modern of a company, and therefore when they return shareholder returns, this will be from increasing in price to earnings multiples, at which they're only trading at around 19, whereas the industry standard, I believe, is 31 times earnings. And therefore I do feel that this has a sustainable path for growth in the future. If you're interested in my legal and general stock analysis, then click the card at the top right of the video. This is the Osborne Foreman Show. Thank you for watching and putting up with my bad jokes that were excessive this video. Stay safe.